Attention to the neglected and underserved community of investors. There is an alternative real estate investment opportunity for the average person. Money is only a tool that gets its power and value from the people who know how to properly use it. For decades, it has been about high net worth individuals and institutions. People need a real financial vehicle so they can be represented within the Wall Street ecosystem that is for the people, by the people, and of the people. Introducing the power of Co-openomics. Consumer Cooperative Group is committed to revealing the power that the lower and middle class investors have already possessed by redirecting it through Co-openomics. By taking the neglected and underserved market of retail investors, introducing them to Consumer Cooperative Group's journey and process from pre-IPO to a listed and publicly traded company using the crowdfunding method under the Jobs Act, this funding method will eliminate the need and burden of entertaining the traditional venture capital dog and pony show as well as other financial intermediaries. People have been funding things that have been controlling their lives instead of funding things that will allow them to control their own lives. To learn more or to get started as an investor today, visit Consumer Cooperative Group at ccg.coop. That's ccg.coop. Early investments are now open.
Universe. Media. Network. 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 Network.
This is Antonio Holman, publisher of United States Real Estate Investor, and welcome to another exciting episode of Features, where I have in-depth conversations with people who make this industry so exciting. Today I'm talking to Tanen Andrews, who is the founder of Consumer Cooperative Group, something really exciting for underserved and underrepresented people in the United States. Tannen has built something really incredible and has been working on this for quite a long time, roughly about 25 years or so. And I think this is an extremely exciting venture that he's creating, and I hope you will too. Please sit back and enjoy this in-depth, very detailed conversation with Tanen Andrews. All right, so we're here today with Mr. Tanen Andrews, who he's developing something pretty amazing for a lot of underserved communities here in the real estate investing space. But before we get started here, Tanen, let's get into a little bit of what your personal life is like.
Oh man. It's kind of tricky. It's a lot of things going on, man. Teaching the kids, man. I homeschooled the kids, teaching them, bringing them up on business, not having the traditional ways of saying, hey, I'm going to go to college and then I'm going to go find a job. Like, no, you're going to go to college, you're going to start a business. So a lot of that goes on in the household and stuff like that. So all my kids are grown now. They're all adults now. The last one just turned 18 in June. And then my 20-year-old just had his 20th birthday yesterday. So yeah, it's kind of tricky balancing the family life and trying to run a business over the past 20 plus years. Yeah, it's been kind of ups and downs in there, like with the misses and all that.
So did you get any pushback from the kids when you were aiming them towards business ownership instead of working for somebody else?
Well, not so far, not the last two. My first couple, they're kind of little knuckleheads a little bit. Like I got two older sons. One's a college graduate already, and the other ones, the two are just floating out there. And I have a stepson, so that makes that six. So I have a stepson. Yeah, he just went into the military. So those are the type of things that we try to explain to him, beforehand. But he got caught up in the situation, and now he says, "Okay, I got to go do this." So I said, "Well, that's the path you should have took before." But like I said, they got to go out there. They're gonna bump their heads and trying to figure out what's going on, and they just got to realize this is work. It doesn't matter what you aim and put your what you want to do. It's going to always require some type of work and some type of mastery over time. So
okay, Tannen, briefly tell us What is Consumer Cooperative Group, and what is what you call Co-openomics?
Well, Consumer Cooperative Group is a cooperative, and I think traditionally, I think a lot of companies, a lot of people are brought up in thinking, hey, incorporation. Well, some, because I got a little story on that one. Incorporate, get an LLC and whatnot. But one of the things that what they've not been putting out there is what a cooperative is. And a cooperative is the original form of an entity that was in place previously before there was any type of incorporations, any LLCs or whatnot. And what a cooperative is where you take members of the communities that have different maybe products or services and stuff, and they pool their capital resources together to provide those resources to everyone within the community. So, and that's the sustainability. So when corporations came in, corporations kind of took the place of that, and cooperatives kind of just slid to the back, to the back end of it, but they're still there, but they're not forming. Because I know if you heard of a anything that says cooperative, collective, or like they're usually are associated with utilities or credit unions. But at the same time, they're functioning in that capacity, but not in the capacity as the original form of what a cooperative is supposed to do. Because the cooperative is like the bank. It's like, hey, we need to say for instance, farmers, a farmers cooperative. That's another form that they were using. So if you have a certain farmer has a certain crop and another one has another type of crop, they would take one crop and they would exchange. That would be their specific currency at that particular time, and that's pretty much how the communities sustain themselves. So now what co-openomics is, it is cooperative plus economics. Put that together, that's what you got, co-openomics. And that's what we need to get back to. We need to get back to the original way of doing business amongst ourselves. And so we have to stop delegating our authority and power over to third party intermediaries where they're controlling the outcome of what is being provided to the communities. They're kind of like they're creating scarcity in places that don't need to be scarcity there. They're manipulating the this inflation that's being created. We had a meeting we had a video on Friday where I talked about I started my series, Knowing the Ledger, the Power of Bookkeeping Entries, which is what is money. That was the first episode. So we went over that, how all of that takes that process of money creation and all that, and how that takes place, and what creates this disconnect between what is money, what are we using for money, what do we consider money, and how we're trading our personal time and our labor for money, when it should be the assets should be producing the capital and the money for us and not us. Because I think that's where a lot of the um, the issues are. People don't have enough time in the day to do certain things, to be with the loved ones, take vacations, do certain things, and you got all these like gurus and all these things on the media just shooting at them saying, hey, I can make you rich and I can do this and stuff. But people don't have that foundational knowledge regarding what money is, and time and money, opportunity costs, all these different elements. So what co-oponomics is trying to do is trying to bridge that gap, bring it back to the original, bring it back to the point to where we're educating the people first. It's like, hey, look, this can be done, but let's learn this first here. We have to learn the concept of what money is. So when we move through our process, you'll start to understand what's taking place as we're moving along. So then you can understand, hey, yeah, there, I see what the change is. Okay, now you have to see what people want to change. When you say you want to change something, people, the only way for people to change something is they have to understand what they're changing from. You have to give them something, uh, an alternative, because you can't produce something to somebody and then you don't give them an alternative, and you have to explain what that alternative is, because remember, they've been conditioned over the course of their generations, many generations. They've been conditioned to think a certain way. So when you come with something that's completely, you know, different, but it's concrete at the same time, and then you show what the connections is and where the manipulation is taking place, then you give them a foundation where they can start from, you know.
So the other thing that's interesting about what you're doing, on the surface, most people would say that this sounds like a real estate investment trust to me. What is the difference between that and what you're doing?
Well, the real estate trust, again, there we go. We have to start defining words. We have to start um, understanding the definitions of words. And a trust is a one of those financial business entities that are started, uh, to protect assets and separate people, separate themselves from an entity. So, so the first thing I would say on that is, okay, what is a trust? A trust is an instrument or a vehicle that holds and protects assets. So that means you would have to have three parties to that. You would have to have a trustor, a trustee, and a beneficiary. Now, within that trust, it has to have assets in it. So yeah, they're similar, but at the same time, the difference is that the cooperative, we're pooling funds together as a group. And when we do that, what happens is that now we want to acquire, in our situation, we want to acquire multiple, several million, hundreds of $1 million worth of real estate. So if we pool our funds together, that capital that comes in exchange for that capital, they receive stock, okay, equity stock. So that would be the exchange there. Now, the benefit from that is now they don't own the real estate, they own it indirectly through that piece of stock. Now, that stock can act like a derivative, and a derivative is something that's different from, something that's in lieu of or place of the actual asset. So they're exchanging an asset for an asset. You see, now a trust is just pretty much saying, hey, a trustee, you have a third party intermediary, which is the trustee. He has a fiduciary duty to administer that trust for the benefit of the beneficiary. You see what I mean? So now the beneficiary is at the beck and call of the trustee. The trustee can run it. He's like the manager. He can do whatever he wants, and the beneficiary has to comply with whatever rules whatever the trustor set up for that trust. They pretty much have to abide. The trustee has to abide by those rules and administer the trust for that, and the beneficiary has no control. The cooperative is completely different. That stock, once the members or the investor has that stock, they have the ability to do whatever they want. They don't need to come to me or the CEO or whatever, the founder or whatever, and ask, hey, I need my money. But we're creating an environment to where, hey, we're going to register these shares, we're going to make them liquid, so that way people have access to their investment benefits. You know what I mean? So the benefits of holding stock, and I don't think people really understand what the benefits of stock is, other than from what they have their 401ks. You know what I mean? So if they have their 401ks, they pretty much, from their job, they pretty much have a third party uh, administering their account. You know what I mean? They're taking money out of their check, and then they're picking and choosing what what companies or what stock that it's going into. So it's like, there's not really any control. And then if you want to pull your money out, then guess what? There go the fees. They're gonna hit you with your fees on your money. So that's the disconnect right there. So, and I think with the new legislation that came in with the Jobs Act, being able to where regular individuals can directly participate with startups and get stock at a hell of a discount versus going before it gets to the retail market is a big advantage for them on that. But we have to educate them and let them know, hey, this is what stock is, this is what it is, and I think we'll get into into that process where we're talking about the manufacturing, the wholesale market and the retail market, and in that supply chain. And people have to figure out what section of that supply chain do they want to interject their capital into. What part of that do they want to be in? The manufacturing stage, they want to be at the wholesale stage, or they want to invest their capital at the retail stage, because there's different levels. And they understand it, but I don't think they've seen it applied to the financial world. But if you go into the consumer world, they understand the concept of manufacturing, wholesale, and retail, because they're buying clothes at retail, right? And then they're waiting for it to go on sale. You know what I mean? So they understand that concept. So now we have to apply that to the finance market, and how that they need to be able to stack their assets. And it's all about asset classes, and there's more than one. Real estate is not even though this cooperative is real estate, but it's also building additional asset classes, and it's also converting them from what they call a non-accredited investor into the accredited investor. So the process of Co-openomics is to change individuals' asset holdings, as well as their classification in commerce, from non-accredited investor to accredited investor, because that opens up other opportunities. Because people are thinking, we have a lower class, we have a middle class, and we got an upper class, right? But there's only two classes: non-accredited, and accredited. That's that. Because the accredited gets all the opportunities to do certain things to build assets. That building those assets also builds wealth, and it also maintains that wealth as well at the same time. And maintaining that wealth is basically from making your investors sustainable. If you make your investors sustainable, and what I mean by making them sustainable is that when they give you capital, you have to give them something in value is equal or more. Because what you're doing is the sustainability comes in, because if you're taking care of the investor and your investors and your members of the co-op, what happens is that they're sustainable. They can pay for the services, they can invest, and that sustains and keeps the company going. And then from there, it's just a revolving door. Whatever the company creates and profits from, because what we do is we split profits 50-50. Because we look at all our members and investors as equity, as JV partners, in a sense, right? So whatever comes in and whatever goes back out is split 50-50 between the company and how many, depending on how many shares that each individual takes advantage of, their earnings will be based on their per share holding. So.
All right, Tannen. So you've been doing this for approximately 25 years. You've been developing this organization for about 25 years. So what is your business background that led you to the creation of Consumer Cooperative Group?
Mainly it's business, business school, entrepreneur school. It's a lot of variety of things. Not just that, but actually I think my unique approach to it is based on personal experience. Um, I always dive in head first. I don't question myself when I do stuff. I go in, that consequence. If it's not right, I deal with the consequence. Hey, I don't look at it as a consequence. I just look at it, I just built another step. So once I build that step, I know, I don't take that route anymore. And I say, okay, now it perfects it. But like I said, I was fortunate enough to have a mentor, early on that didn't charge me. You know what I mean? Because you got a lot of these people out here today hollering about, hey, this costs X amount of dollars and da 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 to do this, and information should just pretty much be free. And that's what he did. He gave me the information. He gave me the knowledge. He said, now I'll point you in that direction. It's up to you to do what you need to do. And that's pretty much what I did. He gave me what I needed. I went to that and I found out some stuff. I had some questions. Then come back and I said, hey, I ran into this. Okay, now go here, look this way. So he was letting me trail my own path, and as I was coming up to certain situations, then he would help me, guide me to another path. So a lot of the practical experiences dealing with real estate from the foundation of it. Um, yeah, there was no specific techniques. I just learned the rules and procedure. Just like in math and algebra, you have if you have to figure out and try to solve a problem, every problem in algebra has some form of formula. So business is the same way. They have different formulas that you use in calculation that you would do to create a deal and do whatnot. So when we did the deals, so when I did the deals were just pretty much in the sense of just based on that scenario, uh, working the numbers, a lot of creative financing at the beginning. So that's the foundation of it. I was created from creative finances from the get go. You know what I mean?
Yeah.
Try to you have to tailor the deal to make it work for you. You can't just take somebody else to say, hey, you can do this and you can do that. And I'm like, no, you can't take what someone else does, because their results and their situations is completely different from what you may experience, because your experience is not probably, and confidence is not probably as confident as the person who's teaching you that technique. So you got to kind of feel it out yourself, and kind of go with the flow, because sellers, you got different type of sellers and stuff like that, different type of, and that's what we were talking about earlier, the personalities. If you don't know those you have to learn those personalities so you're able to adapt. And that's pretty much all real estate is creative financing, adapting to the situation. Um, uh, and then back then we're learning about lender programs. You know, lender programs, they come and they go, right? Some of the programs that I had back in the 90s, those programs are now back. They're coming back a third time. So since I started in the late 90s, right? Those same programs, them zero down programs, all of them, they'd have made an appearance about 3 or 4 times since I started, up until this date. And those programs are back now. So it's it's just like, but now what happened is the background of it. It was the having finding out certain things, about the concept of money and what the banks are doing. Are they really loaning money? All of those things started to come into play because of different people that you're meeting. You know what I mean? You're dealing with some of my knowledge and foundation comes from, like I said, it all comes from practical. It's no nothing that I do is theoretical. Because theory, you should know, theory is something that is unproven, right? So everything that I teach and everything that I show is all based off practical knowledge, practical experience, and what they call folk knowledge. So I'm taking folk knowledge and I'm passing it down from generation to generation, whether it be through my line of generations or someone else's line of generations, so to help us change a lot of things. So a lot of knowledge, again, like I said, when I say it's passed down, a lot of the knowledge I have, not just from my mentor, but I've had knowledge coming from attorneys. I've had knowledge coming from judges. I've had the knowledge coming from bankers. So a lot of so taking that and them pointing me in those direction and me saying certain things to them and teaching them certain things as well at the same time, that helped me develop uh for help me develop my technique, my learning patterns, and my teaching patterns on how to teach people. And I think that I can teach people real good because I can take it down. I know how to take myself from a leader position and subordinate myself down to a follower and let someone else lead. You see what I mean? Because that's a confidence builder for a lot of individuals and stuff. They have a perspective, and you have to let them shine with that perspective. And sometimes you have to step back. So I try to be a leader creator at the same time. So that's pretty much the background of what I've established and what I'm doing in the business. And it's not just, you just can't just focus on the real estate. And I think that's where a lot of people lose it when they see this on TV. They're like, well, people like, hey, hey, we're gonna make you all this money and we're gonna do all this and stuff like that. But you're not giving them the foundational, uh the conversation. Let's have this conversation. Let's sit down. Let's project. You know what I mean? Let's project something. Let's plan out the scenario and stuff like that. And that's something that that background that I've established over that foundation, along with the schooling. You know what I mean? So, holding, well, I don't hold my master's yet. I'm only a couple classes away from two masters. A matter of fact, my master's in business and my master's in entrepreneurship. With the So it's kind of been difficult, trying to run the business and finish those last few little classes, but at the same time, I'm completing those classes while I'm actually experienced, because people go to school to get the knowledge, and then when they get out of school, they go and get the experience. But I don't
Yeah.
think anybody's there that's actually sat there and thought about, hey, no, I went and got the experience first, and then I brought that experience to class. So I brought something of substance to class that's the class has never heard of, and the professors has never heard of. So I had a lot of professors, communicated with me more, I think more than the other students and stuff, because they were trying to learn what I was learning, because it was like, well, no, it makes a whole lot of sense, especially that's when I teach as well, is I make sure I cite my work. You know what I mean?
Yeah.
And that's one of the things that I learned in school. See, school will give you certain bits and pieces that the streets won't give you. You see, so you go to the school's teacher will, no, cite your work. That gives it authority. I'm like, oh, you see what I mean? You don't get that
Yeah.
from the streets, right?
No.
You know what I'm saying? You don't get that from the streets. So when I heard cite your work, I'm like, oh man, that was in the early 2000s. And when I learned about citing my work, that's when I got into the legal aspect of it, dealing with the Uniform Commercial Code and all of that, and the commerce and trade on the U.S. Code. And that's when I started studying that, and I started to understand the purpose of citing your work, because in the Uniform Commercial Code, annotated series and stuff like that, and the U.S. Code, That's all that they're doing. They're citing information resources from where they got the information to bring authority to it. So I said, okay, that's the piece that I need to master. You know what I mean? I need to master that piece. So that way, when I'm talking and I'm saying this is practical knowledge, I have practical experience. I can back it up with the authorities, from several years, 70 plus years back, so people can understand, well, wait a minute, this business and the model that you're bringing to the table that's different from everyone else, which is innovative, because the innovation is being able to change the minds and the habits, the financial habits of the communities that's been classified up under the retail classification. You see what I mean? So you're changing their mind and their thought process. That's the innovation. You see what I mean? Because people think, oh, I'm going to create a product. Anybody can create a product. Anybody can create a service, right? Anybody can create that. But can you change the minds or the habits of the way people operate? Can you change their financial situation? Can you change that? Can you give them something? Can you create a vehicle? Can you create a service that uplifts them, that changes their lifestyle? That's innovation. You see what I mean? Because you want to remember, I want those people to come in, but hey, they have to be able to afford what I'm being able to offer, right? So you got to lift them up. You see what I mean? Lift them up first. Once you lift them up, guess what? You'll have finance forever. See, that negates the people negate the they negate the third party intermediaries. Intermediaries, why do they have intermediaries? This is something that you learn, and this is something that was taught and that was learned through this process. Is the power is with the people. Everybody is going after their capital. So it's like, okay, well, wait a minute. Don't say, so the authority is not with you, it's with the people. I was like, okay. So I said, well, we need to start focusing on the people. You see what I mean? We need to start uplifting them. We need to start putting them into a situation to where if I change their lives through my innovation is that knowledge, is that knowledge that's being passed down to them that they've never heard of because they've been conditioned. We have to change that conditioning. We have to let them know, hey, you guys got other alternatives. There's other options. You see what I mean? And they've never been provided those other options. It's always been, if you pay attention, it's only been one way. It's always been a one way uh, scenario, even with marketing, with products and services, with all type of entity. They want you to buy something. They want you to buy something that's a product or a service that's going to be obsolete, or it's probably already obsolete when they buy it. You know what I mean? Just like with a car, a computer is a good example. The technology is already obsolete. So now you come up with something new, and Apple is a perfect example of that. They self cannibalize, right? They self cannibalize their products and their services all the time. And when a product they release is obsolete, a year later they want the people to turn around and spend that type of money again. You see?
Right.
But when I bought this product, when you buy that product, did it change your life? Did it change your life financially? You see what I'm saying? What type of value did you receive from that product or that service over the course of that year? And that's what I point out. That's what we do. And that's in my background. That is what we have to bring to the table. When I issue you something, if I issue you stock, the stock is the product. not the real estate yet. I'm gonna give you the stock, take the capital, purchase the real estate. The real estate becomes the financial asset base for the value of that stock. That stock represents a partial equity ownership in that real estate. Okay. Now, they can do whatever they need to do. So what we need to do is bring that value, create more value based off that real estate, that cash flow and whatnot, and do whatever to bring that value. Now I'm uplifting their financial situation, which changes their psychological state. You see what I mean? And it changes, and when they change, everybody that's around them starts to change. Because like, hey, what you doing? They introduce the cooperative to them.
Right.
They get involved, and next thing you know, you're branching out. You see, I'm not hyping anything, and that's one thing we're not. That's one thing that you don't learn. You learn the patterns. You learn the patterns over the past 25 plus years. You learn the patterns of the way that marketing is taking place, the way that people are approaching consumers or people and whatnot. You see, and you change those patterns. You see what I mean? Because you're hyping them up. If you have to hype a product, then it's not worth it. You see what I mean? If you have to hype a product, if I say that want us to pool our money together to buy real estate, so then, and give you guys stock, and then register that stock for you to be, so that stock can become liquid and trade just like a Fortune 500 on the New York Stock Exchange, that is not hype. That's a reality that we're trying to, you see what I mean? Hype is something that's you hyping something out of nothing. No, I'm not giving you hype. I'm giving you a path to where we're gonna go. You see what I mean? So that's the difference. So I don't get into that marketing in the sense of where it hypes up. And I've had a couple of agencies that I don't do business with because of the way that they're going to market, the way that they're going to market it. I said, if you cannot address my niche market the way that I need for them to be addressed, you see what I mean? Because you can't give, like you said, you can't give baby a steak, right? So why would you give them something that they don't understand? I don't talk. Of course, I can talk the business lingo. I can say a lot of things, but that's just like hearing myself talk. That'll make me, make me sound good because I can talk. No, I have to humble myself, bring myself down, talk to them as if we're having a cup of coffee, just like what we were doing yesterday. You see what I mean?
Yeah.
That's how I approach my audience. That's how I talk to them, my niche market, and that's how you want to deal with them. You want to deal with them as if we homeboys or homegirls or whatever. That's how you want to deal with it. Hey, this is what this is, and blah blah blah. And they have to be in a position where they're relaxed. You see, because what do they do when they're trying to sell you something? They're trying to induce you through some type of, you know what I mean? Some type of emotion for you to respond and act according to that inducement. You see what I mean? No, we want to make sure our people are comfortable. We want to make sure that they're comfortable enough to where they can ask questions and don't feel like that question is not a good question. I say every question is a good question, and so you have to keep them in that situation. And that's what my background has developed into, and has taught me how to deal with a particular market, because that market is my foundational market, and that's the market that I chose and I choose to deal with on that particular level.
And the other aspect I want to touch on is your background is based in real estate. So what I want to know is what was that spark that helped create the evolution of this organization? I mean, this is a stock market play and a real estate play. What created that connection there?
My first deal. My first deal. The first deal. I bought a house. I bought my first house. My mentor helped me. He was guiding me through that. And when I bought that house, with no money down, and I got a $15,000 check. I was like, oh man, I said, it's over. I was like, because he told me, he told me that creative financing, you can do a lot of things. So you can close, and you can get paid at the closing. I'm like, what do you mean get paid at the closing? I'm like, you have to show me this. Yeah, it's ever since he showed me that, it was like, oh man, my head just starts spinning every which way on how to do this. And yeah, so I outgrew. And there was a one point where I actually outgrew my mentor, because he was like, man, you going into some territory I don't know. You know what I mean? So he's like, you on your own with that, because I don't know how to help you. And I think the next deal I did by myself. I think I bought 32 units. They were made up of duplexes, triplexes, fourplexes, single family houses. There was in a package, and this is where this extended on that spark, and that's when the sellers that I was dealing with, all those properties were in an entity. And I was like, well, wait a minute. I said, instead of buying the real estate, why don't I just buy the entity? And it's like, oh, that's interesting. I said, let's try that. I never tried that before. It was just like, that's what happens. When you get into a situation and you're making money, you're thinking about all the ways that you can be creative and do a lot of things. And not knowing this, not in the business world, me just getting into the business world deep like that, corporately getting in there. I didn't know there was a technique for that. I didn't know that was a way that the commerce works like that. You know what I mean? So I think a lot of like in school, and you see these different scenarios that take place and stuff, and they got names for them. You don't think that? I think a lot of people think that people are creating these techniques, but these techniques are not created. Because I didn't know that this technique was created. That's the first thing that came to my mind. So a lot of this stuff, a lot of business and a lot of things that we do, we're naturally born with these business instincts. It comes from our generational, that comes from our generation and our DNA. My family is a line of business. My great grandmother, she was a real estate owner. She owned juke joints and which people call those bars and clubs back in the day. She owns several of those in Georgia, and so it's like, okay, I must have the bug. You know what I mean? I must have that bug, because I'm thinking this. But anyway, we ended up doing that deal, got it done. I think I walked away with 25,000 on at the closing with that, and bought the LLC. The LLC was within the real estate was within that LLC. I think it was a corporation, or one of the two, I can't remember. And all I did was just transfer all of that into my entity after that. So because the closing cost was little, I mean, the title work, it was a little different. That process is a little different. It's still the same process, but it was a little different because we were buying the entity we were buying the entity. It was just like without. I guess that was my first. Technically, that was the first merger. On the private side, if you think about it, you know what I mean? Because I bought a company that had assets, and I didn't know what the hell I was doing, and I did it. You know what I'm saying? Like,
sometimes ignorance is the best teacher, right?
Yeah, exactly. Well, I don't think I was ignorant. I think I was just, I think I was a little out of my, I didn't know I knew enough to do it, but I didn't know the power of what I did until later on. When I look at it now, I did some hardcore stuff. When I look at it now, I'm like, oh man, I could have did this way, I could have did it this way, I could have, you know what I mean? It's like, oh damn, that's kind of what I mean, that I was in a little over my head. And then the next one, I'm like, okay, man, let's do the next one. The next one, when I bought a 12 unit, and it was like, so I would talk about mental. He said, what? I said, how are you doing that? What I mean? 'Cause he was tripping. So he was tripping, it was like, yeah, he said, man, I done created a damn monster, it's
Yeah.
like, that is crazy. He said all the people he's ever taught, he's have never had anybody move like that, It's like, you must have been ready. I was ready to rock and roll. But that was the spark. And then that led into, I think that was in the 98. That led into the Securities and Exchange Commission to stock.
Mm-hmm.
And I was like, well, wait a minute. I said, man, I need to go public with this. So that's when I created my first business. I think it was 97, 98 when I created the first business plan. It wasn't called Co-openomics then because I didn't know what it was called yet. You know what I mean? So, but the concept and the plan of it, I said, look, the only way that I'm going to be able to do this, I got to be publicly traded. I said, and look, man, I'm not even 30. I'm like 24, 25, and I'm talking about some stuff like that. And I was like, and I don't know what the hell I'm doing really. You know what I mean?
Yeah,
and I'm talking about. So, man, that's when I dug deep into the securities, learning the whole method about the securities. So I started studying that, and then coming to find out how difficult. That's when I realized what I know now is what I knew then. And I like, we're not going to be able to do this because that's, first of all, it's too expensive. Because I think the minimum was $1 million for you to even to be able to do a road show, to start to do all that. The process was just so difficult, man. It wasn't gonna happen. So I already knew it wasn't gonna happen. So I was like, but I continued to study it and prepare it and doing everything. And then I started my logistics business. Well, I had a logistics business back in '92 before I started the real estate. So I took the money that I was making out of the real estate to expand my logistics business, where I had 3 delivery trucks, box trucks, and I was delivering. I had a contract with Sears, and I was doing that along with the real estate and flipping back and forth and all of that. And that's where that spark went. And I think that and the feed onto that spark, the next spark is when I bought I don't like to tell this story, but I'll tell it anyway. Because I told everybody over there. I met a builder. And he was building a house. He was a brand new guy on there. So, and it was in Southwest Dallas. And this is where I took the real estate to another level. And this is why I used that creative financing. I only had $15,000. And you know why I don't like to tell this story? Because I see this crap on YouTube talking about where these guys talking about, I had $200 in my pocket and now I got $2.2 billion in real estate. And I said, I said, BS, dude, come on, man. I said, that's deceptive. And you know what I mean? And there's no context to that. So I'm going to go ahead and explain it, and I'm going to bring context into it. Okay. So he was building houses, and he was looking for somebody that was a steady buyer. And I said, well, wait a minute. Okay. Well, I mean, we can do this. So I had a lender. Out in Yorba Linda, California. And me and Kurt, in his company, we did the multifamilies that we had previously, right? In the late 90s. And I said, so I went back to him. I said, look, this guy, he's building, we want to do this, blah, 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 this. And he said, okay, yeah, let's go ahead and do that. So he was an underwriter. He got his underwriting license to where he can underwrite and stuff like that. So what happened was, I told guys, I said, look, I only got $15,000, man. He said, well, I need you to buy. I said, can you buy all 25 houses? I was like, I said, yeah, but we're going to have to sit down and talk, right?
Yeah.
We're going to have to figure out how we go do this. He's like, okay. So took the first 15,000, right? I bought all 25 of them with 15,000, with the same 15,000. Literally, I bought it with the same 15,000. So now let's put some context to it. right?
All right.
It took me 6 months to close on all 25 houses because we were doing rolling closes. So I would give the builder the 15. I would bring that $15,000 to the table to pay for whatever and do whatever, and then before we went to the next closing, he gave me back the 15,000 on the back. And then I took that 15,000 and brought it back in to close on the next one, and so on and so on and so on. It was my same. So at the end of the day, at the end of the last closing, I got my $15,000 back. So actually, I bought them with no money. You see what I mean? I just used that 15,000, and we bought $10 million worth of real estate.
Very nice.
So that was a creative process. Now, I don't know if it was legal or not. You know what I mean? It went through the title company. Everything was fine. It was just creative. So there was no deception because me and him were working together. So, and we could do that. You see what I mean? So it was disclosed. So, hey, we did. But I wouldn't teach nobody to do that now. You know what I mean? That's just something that, you have to figure out. People have to figure out on their own how to do certain things and how to to do that stuff. But those were the sparks. Those were the sparks that sparked me. And like I said, over the past 20 some years, those are the things that I was mastering. I was mastering the SEC rules. I was mastering the business and commerce laws. I was mastering the U.S. code and stuff like that. I was mastering the banking aspect when I found out about the banking. I think I found out about the banking in the late 90s when I found out about the banking thing about the money. That's when I really started learning about money, what money really is and what it's not. And that's a crucial, and anybody that's probably listening to this, and I'll release that. I'll be releasing that video. So look for that video, and it's a series. So I don't know how many episodes it's going to be. It's going to go as long because I'm going out of 3 Federal Reserve publications, that they wrote. These are not my words. This is their policy. This is the way that they do things. So that should be an interesting for you, because I got PowerPoints with it and stuff like that. I'm breaking it down. I'm going slow, questions, looking for questions and all that and stuff like that. And I'll be expanding on them for people to understand that. But yeah, when I found out about money, that really was the precursor for everything else. When I found out what money is, and I knew that I could create that through a corporation. Create that through a corporation, cooperative, whatever, a business, a legal business entity. And that's one of the main things that my mentor taught me, is that when you operate in commerce, you need to be operating as a business entity, a legal business entity. Because I think a lot of people out there now, they're out there doing business and they're doing stuff, but they're not doing business legally. Not saying that it's illegal, but they're not doing it legally, in the sense they have all the liability is placed upon them because all they're doing is hustling. And that's where the liability comes on. So you have to be able to separate yourself from that liability, and that entity is what does that. Like we talked about the trust, the same way. You're just separating yourself from the liability, because you want your entity to be the asset that produces stock. You know what I mean? And the value comes from the asset holdings and stuff like that. And that's producing, the asset is producing your cash flow. So that way, so your time is not producing the cash flow. You don't want your time to produce the cash flow. You want your assets to produce the cash flow. So that's one of the main things. So it's just a combination, man. But like I said, the main thing was the money. When I found out what money is and what it's not, gold standard, all of that and stuff like that, y'all have to just check that, check that YouTube video out when I get it uploaded. That will, that process will blow your mind. So I knew that did it for me, and it's gonna do, and I know it's doing it for some. I got 20 investors now. And I know it's doing it for them because they're like, they're like blown away with that. This is what's going. You know how you can walk around? It's like it's like we're walking around in an insane asylum, right?
Yeah,
Without
without a doubt.
without any bars. You know what I'm saying? Without any
Yeah.
locked doors, we're just walking freely, and we're insane because we got all of this commerce and this electricity and energy going around us and stuff like that, and we can't connect to it because we don't have a circuit yet. We're not tied into that circuit yet, so that's one of the key things that I want to do. Make sure we get this information out, start tying the people into tying them into the circuit, into that, so that way they can tie them into the circuit, be able to get them that currency. You see what I mean? Because it's a current. So we got to tie them in so we can, but we have to do it ourselves. We can't do it with everybody else. We have to do it within ourselves, so that way we can control. Because us as a people, and this is very important, us as a people, man, we have to, when we get financially sound and knowing what money is, and building our network and building our assets, once we do that, what happens is everything else goes away, man. Racism, all of that stuff, all of that goes away, because now what comes in is respect, because they're only going to respect us when we have equity. When we have that equity, nothing else matters, because the racism controls the economics of things, right? So when we get our equity, they can't control our commerce anymore. And that's very important, because when we control our commerce, we control our production, we can start to control our supply chain. And it doesn't have to be like, oh, we got to get a big city to do that. No, you got a network of 100 people or 1,000 people within your community, man. Do you know how powerful and strong that is? Especially when you connected with co-openomics, because you got to remember, if I touch 100 people in each city that invest in whatnot, right? The co-openomics, the cooperative that they have the stock in, that's the foundation, because that current is coming out to them because they own a piece of the circuit. You see what I mean? Which is that stock. They're getting that. So they're able to utilize that within that community to build within that community. And when they build within each of those communities, which will be our cooperative network, what happens is, when they build in those areas, more money and investment starts coming back to the cooperative. Then the cooperative sends back out more stock out to them, and that brings in more assets and more cash flow, and those profits go back out to them, and that value goes out back to them to hold them, where they can liquidate, leverage, and build within their communities without having to go to a third-party bank. They'll go to the third-party bank, but this is the difference. Third-party bank, you have two scenarios with the bank, right? You got two different type of departments in your bank. You have the regular banking for regular folk, right? Then you have that private banking. We got to get people on that private banking side. We got to get them opening that private banking door, because that's where when they see that you're well, that's the area of the bank where they give you money when you don't need it.
So, Tannen, tell us what is at the heart of the reason for you to create Consumer Cooperative Group.
The community, our niche market of investors, the niche market, the everyday community, everyday people, mom and pops, the youth, all our youth are, pretty much, not just our people, but everyone's that's classified as a non-accredited investors, because they never had. Because we are all pretty much all in the same boat in regards to financial well-being. And I think the system, I know the system, what they do is they use that against one another. And if you're pegging one class of individuals against another class of individuals, you see, then you're missing the theft. You know what I mean? You're missing
That's
the theft.
yeah.
You're missing the theft. Somebody stealing, they got you distracted over something that doesn't really make any sense or is meaningless. You know, you think it's meaningful because they made it to where to make you think that it's meaningful, but really the only thing that's meaningful is having equity. You know what I mean? In everything. Because if you have an equity, you leveling that playing field. And I think we never had that until the Jobs Act was passed in 2012. Because when that was passed, that was laying the pipeline for that sparked what I did 10 years, 12 years, 13 years earlier when the Jobs Act was passed. Oh man, I damn near went insane.
For those who don't know the details of the Jobs Act, hit us with that information real quick.
Well, what the Jobs Act did was it was mainly for, I think, two purposes. It was for the small businesses and for the non-accredited investors, the investors being able to give them access to startups early on. And what that does is that gives them the ability to establish wealth early on for a cheaper price per share. And that's important because you're thinking about, well, where's all this wealth coming from? Why do you see all these people that are multi-billionaires? Why do these people have $50 million, $100 million? It's all paper wealth. Okay. Now you might think paper wealth ain't nothing, but this is one of the things that they did. Once they get paper wealth, you take that paper wealth and then you go start buying hard assets with it, because that's where you get that term paper gain from. Okay. Mm-hmm. You see, so we want to create the paper wealth. You see, so we're able to access the hard assets, which is the real wealth. You see, and that solidifies the stock, because the first thing you know, if you think about Microsoft, you think about Apple, and especially if you think about Facebook didn't have any assets other than their IP, right? So when they went public, right, what is the first thing? And if you guys are hearing it, I want you guys to think about it before you just do anything else. Think about it. What is the first thing Facebook did when they went public? They started buying companies that already had revenue, companies that were of substance, that were generating money. You see what I mean? So they're bringing validity to that paper wealth now. You see, so they kept buying more companies, and I'm pretty sure that they're buying real estate. So let's talk about what we're doing in regards. We're doing the same thing. We're going to create the paper wealth, and then we're going to take that wealth and then we're going to leverage that paper. Then we're going to go buy cash flowing real estate assets. You see what I mean? Now you have a value, a solid value. You see, it's not a product or service in the sense of, tangible things that you can just throw away. You're talking about, you have to look at real estate as real, as in, if it's cash flowing, you can't think about it as in, okay, yeah, I'm getting some cash flow. Oh, I'm good. No, you want to think about it as in the sense of 100 years. Take 100 years, right? That cash flow times 100 years. That's what you're looking at. See, now you have longevity. You see what I mean, of that stock value, and you're looking at, okay, if I have stock in that, then I'm able to pass down generational wealth now. You see what I mean? That's what, and you don't own the real estate. You own it indirectly through your shareholdings. Your shareholdings become the asset in lieu of the real estate, because that stock is always tied to that real estate, to that cooperative, and that real estate is tied to the cooperative. So as long as you have that stock and that real estate and that cash flow, you always have a connection to that real estate. You see what I mean? That's able to pass down. So you don't sell shares, you don't sell your shares. You leverage. And see, that's that new wave of education. What
Exactly.
people, but what is the first thing people do? When they get something, they want to just spend money, right? They want to
Yeah.
spend money, or they want to sell something. They're always trying to sell something, man.
Mhm.
No, don't sell your asset. Your asset is your cow. You see what I mean? The money is the milk, right?
Right.
So you don't sell the cow because you don't get no more milk, right? So
Right.
people get a paycheck every month, right? And they're spending the milk. They're drinking the milk up, right?
Mhm.
Now, what do they have to do? They have to go back to the cow, which is the corporation where their job is, and they have to trade time for money or time for more milk so they can spend again. But if you have your asset steady producing the cow, steady producing the milk, doesn't matter what you spend every month. You don't need to save because you're getting it every month. There's a different way, different ways of thinking. So you want to think about the power behind it is that when Facebook, and I got a slide, I have a video on this too. Facebook, when they came out at $50 a share, right? Let's use a number here. Let's use a round number. Let's say you want 10,000. Let's say you invest with us at X amount of dollars, say a penny a share. Let's just say a penny a share, and you come in with $100, right? That gives you 100,000. That gives you 100,000 shares. Okay, you're stacked now. You're stacked with 100,000 shares because you're like, well, damn, I can't get 100,000 shares in my 401k, right?
Right.
Yeah,
Right.
because that's the retail side, right? That's
Yeah.
the retail side. So now you're in between the manufacturing stage and the wholesale stage, because the manufacturing stage is the company. The company produced the stock, right? And selling the stock to you at a wholesale price produces investment capital, so we can go buy the real estate, right? Because the whole goal is to get to the retail side, because the retail side is the liquidity. That's where you can, now your shares are worth publicly, or worth this amount of money. They're registered. Now they become like legal tender. They become money, or they become the facilitator to get that currency that you need to trade and buying goods and services. So instead of selling your asset that's connected to the company, you leverage it, you borrow against it. Because now when you go to that private bank, oh, you got 100,000 shares, you see? But that 100,000 shares, right? Now let's talk about how we're gonna get to that value, so that way before you get able to leverage that now, and what the Jobs Act allows you to do. Jobs Act allows us now to go straight to Wall Street without an investment banker. Before that, remember I was talking about earlier how it was difficult, expensive, and then you got to get somebody. Then you got to get somebody, try to convince somebody that, oh, could you help me? Could you loan me? Could you underwrite this and blah blah blah? And you're paying all this underwriting fees and all this money and stuff, and then they have to, before you're paying it, they have to want to deal with what you're trying to do, right? Man, all that's out the door. You see, because I started it from there myself. I hadn't used anybody. You see what I mean? They might have tried to hate and try to stop it, you know what I mean, by not letting me, participate, right? But like I said, the job that created that, they created the crowdfunding sites, and they created what they call Reg A, right? The crowdfunding side is what you see now, where everybody and their mama can get on there and put in $100 here, $100 here, and they can get something from whatever that company is offering. Now, what they're offering is a whole different thing. So, and I have to let you guys be the judge of that, because you would have to look at what I'm offering and compare that to what everybody else is offering and then see if it's the same thing. It's not, because I'm offering you equity. I'm offering you stock. You see what I mean? And I'm already have the mindset is, no, we are going to the New York Stock Exchange. We're going to trade. We're going to liquidity. No one's talking about that. You see what I mean? Everybody's talking about, they're just trying to get you to buy products and services that have been rebranded. And that's where I was telling you about the marketing. You have to watch that. You have to pay attention to that, because with any new type of law or service that are being provided by the government, that any laws that benefit us for growth, right, is going to be infiltrated and manipulated by the status quo that was already there. Okay. So I'm not saying that the venture capitalists are doing it, but people are using that type of methodology to kind of manipulate the situation, where people thinking that they're in crowdfunding, but they're actually not, because it's based in venture capitalists. You see what I mean?
Yeah.
They're funded. I said, because the democratization, when you democratize, that doesn't mean that you're pre-capitalized. You see what I'm saying? By venture capitalist money. That's not democracy. You see what I'm saying? That's not democratization. But they lead with that. Hey, we're democratizing the investment world. No, you're not. No, you're not. No, not if you're using venture capitalist money in there. So now, and the reason why, and it's not their fault. Well, what the thing is that when you're using venture capitalists, right, you already have somebody in a power play position.
Right.
You see what I'm saying? That's not democratization. What I'm doing is democratization. I'm letting you come in. There ain't no other venture capitalists in there. I said, even if the venture capitalists do come in, guess what they got to do? I said, no, you got to be just like everybody else, bro. You got to be just like everybody else. You don't get no special whatever. Like, if you buy more shares, your earnings per share is just going to be higher. That's all it is. But you get no more power than everybody else. Everybody is equitable when it comes to us. And that's one of the differences. So, but like I said, so they're putting a lot of products out there that are branded, rebranded with another brand, but it's the same product and services. So they're giving you that, and then they're trying to get to the market. And when they get to the market, then they're going to be looking for the venture capitalists, right? So that still leaves you at a they left you to go to the venture capitalists. So in other words, they didn't respect you. You know what I'm saying? I'm keeping the respect on when we move to the next level. Y'all riding too. You see what I'm saying? Right. You guys gonna be there too. I'm not neglecting you. You guys are cool too. Come on. You see what I mean? So now you have to look at, so now when you're getting there, so now when you get to that value, now you get into the valuation to where you're trying to get that. So if we become public, say the stock comes out at $10 a share, and you got 100,000 shares. Now you have $1 million in wealth. Now you have $1 million in wealth. Now you can leverage and do all that. So, but it only costs you what? $100 to get to $1 million. But then at the same time, you was able to stack 100,000 shares on this side first, before you got over to the retail market. So now, if I got to the retail market and say you didn't invest that $100 at the retail market, right? Now, them same 100,000 shares would cost you how much? $1 million. That's the shift. Yeah. That's the innovation. That's why we're shifting it. We're shifting it to where they're focused to where you pay the least amount of money over here on this side. So that way you can stack your stock up high on the left side. So when we get over to the retail side, you see, you benefit from the appreciation of value for being from a public valuation. You see what I mean? That, and I don't think that's what people not understanding yet, because if you go to my site, right? you go to the crowdfunding site, you look at it, and you're thinking about it, like, well, you go, oh man, he don't got no hype going. Oh no, I don't got no hype going. Just because you look at my stuff and you see that, oh man, he got less than $3,000 raised. I'm like, yeah, and what you see, they got them thinking You see, me personally, if I was to go to invest, me and that might be biased, but no, but that's no, but this is how I really think. I'm not going to the one that's hyped up. Oh, this people they don't raise $2 million, $3 million. Oh man, this is a hot commodity. No, see, that's the problem. Investigate it. You have to research why they're hyped,
Right.
why they're being so successful. Research it. When you research it, that's where our education comes in. So we educate the people about money, all of this and all this about the games and all the like this is a big monopoly, right? Big monopoly game, right? So if we teach them that, they'll be able to see the red flags in that. They'll say, oh, wait a minute, this is hyped up. You see what I mean? So if you really look at the product and service, you're looking at to where, okay, when are you going to be able to get profiting? When is are you just using my money to springboard me forward and I'm really not going to get anything? Am I getting just a t-shirt, or I'm just getting you're looking at, because you have to think about your money. They're talking about, and this is one of the things that you want to look for. If they say, I want you to invest $500 and we're going to give you 10%, you need to run. You need to run. Or even if they say if you get a 12%, you need to run. Even if they say you get an 18%, you need to run, right? You know why? Because $500 ain't nothing.
Right.
You see what I mean? You're paying $500 to get 10, 12, or 18%. That's only $100, $120, $180, right? You're going to get your $500 back, and then you're going to get that. You ain't make no money. See, and that's what they're doing. They're getting you in there so they can get you out. And then they'll give the real deals to the venture capitalists on the other side.
Right.
You see what I mean? No, I'm giving you the real deal right now. You're getting the real deal, because that same $500 that you would have put over there, that's going to get you 50,000 shares. You see what I'm saying? And that 50,000 shares on that other side, when we go to Wall Street, that's going to look real pretty. 50,000 shares at $10 a share, that's going to look real pretty over there. You see what I mean? That's the difference. That's where you're looking for those red flags. You see what I mean? Because interest rates, you have to this is all about tools. And this is why the Jobs Act is so important. They're giving us, the small business, the tools that we need to do the things that we need to do that we normally couldn't do pre-Jobs Act, right? The thing that I wanted to do prior to. You see, now we have the tools to do that. So now these tools are being manipulated. You need the right tools for the right job. So if you have $500, what you're saying to them and to yourself and to the world is that $500 is your wealth. That's all that you're worth.
Right.
So, and you're taking 10, 12, and 18% to maintain a $500 wealth, right? Because how long is it going to take you to make that $500 back? So in other words, you're not building anything. Yeah. You're maintaining the value of that wealth, because that $500 becomes the principal. You see what I mean? So you're not in the business to be in a loan. You're not in the business to be a bank or to loan in that scenario. So that's not the proper tool. Now, if someone had $1 million and they're getting 12, 18%, that's different, because they can live off of that, right? You can't live off $120, $180 a year, right?
Right.
So that's the wrong tool for you to base your investment off of. You see what I mean? That's a wealthy man's tool. And a non-accredited investor, the one that's not that wealthy, you're trying to get them to use the tools that the wealthy use, and you can't do that. That's because you can't use that. There's multiple tools for multiple circumstances. You have to use the tools that we're providing to help stair-step you up to that point. But the only way to do that is that you have to be an equity partner. You have to have stock. You see what I'm saying? Because we're going to bring value to that stock, and your return on your investment will damn near be immediate, because what are we buying? We're buying real estate. We're buying turnkey real estate. It's already, we're buying, look, we're doing real estate. Like when we're buying real estate that already has a history. That's like buying a company. Remember when I told you about the company earlier?
Yeah.
When you bought the company, I'm buying the company that already has the assets. The assets already have the history. So when you're buying real estate, you're buying history. You're buying value, historical value. You see what I mean? So you already know when you do your projections, you already know. You already know. You know what I mean? You pretty much know what you're gonna do. You know what the real estate is going to do. You know how it's going to perform. You see what I mean? So you look at the cooperative, well, you don't have no operating history. I know, it's by design. We don't have no operating by design. Why would you think that, Antonio? Why would you think that I would create a fresh company under the Jobs Act, right? I created a fresh company with no history, and I did it on purpose. Why? Because you don't have no historical issue. Meaning, if somebody buys my stock, they don't have to worry about anything popping up, jumping out, any unknowns, right?
Yeah.
You see what I mean? It was created fresh for the people coming in. We're going to get stuff right now together at the same time. That's why it's fresh and new. That's why it is limited operating. And then the expenses are cheaper in regards to audited financial statements. You see, I ain't pay nothing for the audited financial statement, because you see what I'm saying? Because it's little activity. You see what I mean? So you have to think about that, especially if I'm bootstrapping it. I'm bootstrapping this bad boy. I got 2-3 close to $400,000, almost $400,000 of my own money over the course of these years, right? So you have to think about that. What it would have cost if I would have had to borrow that money, right? That would be a debt right now. $300,000-$400,000. That would be a debt, a lingering debt over the entity right now. That would be a red flag to investors coming in. You see what I mean? Because so that's the purpose of that. So when they look at and when I say that I bootstrap it, you can see that it's being bootstrapped. Why? Because of the audited financial statements. See, people don't know how to read the financial statements, so I don't talk in those terms. But those financials or statements are there, so you can see all the paid-in capital, the shareholders' contribution. You can see that over the time. You see what I mean? So you know that real money is being put into my own personal money. So you hear that term say, "Well, you got some skin in the game, blah blah," in the real estate. Yeah, I got some skin in the game, but not. You know what I mean? Not in that sense. But do you have any skin in the game? No, you don't have any skin in the game. See, but once you know the concept of money, then you know they don't have any skin in the game either. You see what I mean? Because they're actually using credit.
Exactly.
You see what I'm saying? So that's not skin in the game when you're using credit. Skin in the game is actual assets. So we're building actual assets for our investors, our members. So when they do something, nobody ain't gonna be hollering about no skin in the game, because they're actually funding their own stuff off of their own assets. They're leveraging off of their own real estate. So now what happens is we're replacing the leverage and the encumbrance of the asset with the real estate asset with the stock asset. And see, that's where the education coming in now. You see what I mean? You have to separate your asset and your real estate asset. Use your stock as the collateral and not the real property. See, they had us good. You see what I mean? Oh, go ahead and put this lien up against this real estate, and then something goes wrong, they come and steal it. You see what I mean?
Yeah.
You see, no, not anymore. Not with this. This right here, we're teaching them how to replace your asset with your stock. So now we have to bring value to this stock first by using the real estate asset. That's what the Jobs Act allows. Allows us to access everybody that never had the ability to access startups before early, which places people now as underwriters the people are really the underwriter. When you got the guys, people, members coming in, investors, they're actually the underwriter. They're underwriting. We're self-underwriting our offering. That's what's illegal now. We're legally allowed to underwrite our own offering from the people, man. There's no more. That shows you the power. That shows you that power's always been there, but now they're giving it's funny, they're giving us permission now all of a sudden. Why is that? Right? You have to think about that. Oh, so now we're giving you permission to operate in commerce like this now, you know? Well, the SEC got fed up with it. So the SEC wrote, they wrote all this stuff up. You see what I mean? They wrote up all the rules and stuff to be able for us to do what we need to do. You know what I mean? So you gotta think about it. Oh, you're giving us permission now. You see? So, but then you still got those people trying to manipulate it to keeping us. But see, I'm pure. I'm the pure. Like one of the crowdfunders said, man, Tannen, you are the entrepreneur of entrepreneurs, because you doing everything from the beginning, in between, and out. You're active in everything. You the paperwork, you're drafting the legals, you're doing all of that. You're involved with all. I'm involved for a reason, because you're not finna come up there and talk about, hey, well, Tannen, you did something, somebody did this. No, you'll never have me someone else. I'm gonna take responsibility. I said, no, I did everything. I'm responsible. Everybody has a direct path to me. They said, well, okay, something goes wrong. Oh, we're gonna call Tannen. We're gonna shoot it. Yeah, because I'm the one that need to have the answer. You see what I mean? Yeah. I ain't gonna be able to. I can't scapegoat it off on nobody, because I'm letting you know right now, I did everything. You see what I mean? So if something go wrong, it's on Tannen. It's always on me. You see what I mean? And that's the purpose. So, and plus, by it being all on me, I can control the outcome of it. You see, I can block. I know what to recognize. I know what to block out. I know who's trying to stop it. You know who's causing issues, trying to, you know what I mean? Because they don't want this. They don't want this type of innovation. This is going to shake up real estate funds. This is going to shake up REITs, which are real estate investment trusts. This is going to shake up the syndication market. It's going to shake this. It's going to shake it all up. You see, because we're going to acquire properties that no one else is trying to acquire, that don't want to acquire. And the reason why it's not acquiring them because they're bad. They're not acquiring them because they use a standardized formula that they use so they can make money. So I want you to understand, Antonio, and I want everybody to understand is that the real estate market now, they're only doing it to raise value in these properties, and they're selling them. They're not holding them. They're not holding real estate, man. They're not doing that. They're not, their mindset is, okay, I'm going to raise the value, and then I'm going to flip it, and then I'm going to put 300,000. That's the conditioning that they have investors. And that's the reason why I want to recondition and re-educate this niche market. Look, we're not getting in the market to do this pump and dump like what they're doing. And that's what that technically, if you think about it, that's what that is. They're pumping and dumping real estate. No one is holding it. No, we're going to hold. We're going to advance it. We're going to hold. We're going to create that value, right? And that value, we're going to let that value trickle to the stock price. And when that value trickles to that stock price, and this is very important, Antonio, I want you to really think about this for a minute. If we hold real estate and we say we come out at $10 a share, right? Okay. And you're holding 100,000 shares and you got $1 million worth of real estate, correct? Right?
Mm-hmm. Okay.
If we're holding real estate, right, and we're doing renovations, right, or we're adding solar on there, and we're creating deals for our for our tenants and stuff like that. We're providing them subsidies and stuff like that. If they're a member, we're providing them subsidies. Those subsidies become write-offs for us. You see what I'm saying? All these little techniques and stuff. That's where I learned that creative stuff from, man. All these little subsidies, man. So if you see a rent increase in your area, right, because the market is saying that the price is going up, right? You see, we can pick and choose whether we want to do that or not. We don't got to go with what the market says, because we got members. We got people that are members in our co-op in
Yeah.
here. But I'm gonna take it one step further. Just say we got a property and it's $1,200, and then the rent increase goes up. Rent increase I think goes up every 3-4 years, something like that.
Yeah.
I can't remember, whatever. So say it goes up $300. So now the market is saying that our rents go up to $1,600. We'll put it up to $1,600, but then we'll give them a subsidy of $300. You see what I'm saying? That becomes a write-off, because that becomes a credit that we give. That's
Yeah.
what I'm talking about, debits and credits, man. Cats don't know how to use that crap, man. They don't know how to use that because they don't know about that, man. So we can do our
Right.
own debits and credits. That's how we're creating and dealing with money, by giving credits and debits through through subsidies and stuff like that. So we can still keep our valuation at $1,600, which raises the value of our asset. That asset then value trickles down to the stock price. That stock price might be 10. So now all of a sudden the stock price is 20. So now somebody just got $1 million worth of real estate. Somebody got $1 million worth of value of their stock now. You see what I mean?
Yeah.
And we keep it, because you're thinking about the cash flow over the course of, you're looking at the cash flow over the course of 50, 100, 200 years. That's what you're thinking about. You're thinking about the longevity, because you're thinking about the longevity of the leverage from that stock that those people is holding, so they can keep passing that down from generation to generation. Now, if they're leveraging that stock and they're buying real estate in their local communities, right? Boy, ain't that free and clear over there too?
Yeah. Yeah.
That's free and clear over too, ain't it? Exactly.
Yeah.
So if they're taught, hey, over the generation, you guys need to be making sure y'all putting that investment back over into this cooperative to buy more, because that's what's keeping us up. You see what I mean? And if somebody within our network has an idea like, I want to go public, guess what? We're going to fully fund it. You see what I mean? Because then everybody going to get a piece of it. Because it doesn't matter what anybody does. If they want to go public in a different industry, guess what? We already know the path to public. We help them. We already got a list of investors in our network. All we got to do is say, look, we got a company over here, a member over here. They're getting ready to do this. We got to put our money up over here. We're going to set up everything. Everybody go there and make sure y'all put an investment over there. Now we hold in stock holdings in them and let them run their stuff. And now we got new value coming back down to the cooperative, right, from their investment. And then the cooperative still has to split 50-50 of the profits from that value code over there to everybody. So you see what I'm saying? So the money just keeps circulating within that network. And that's what the Jobs Act allows us to do. It allows us to do what these cats has been doing prior to 2012, and it puts it into hands of small business. Now, there's not a lot of small business owners that know what I know. So you know what I mean? So they really don't know the power behind it. But I knew I told you I damn near had a stroke when I with a heart attack, man, when I said, oh no, they not gonna do this, so now I can teach these cats and everybody, get these businesses off and start duplicating. The process is to duplicate what I'm doing with everyone else within our network. And like I said, this is only available to members and investors. Members who are, because if you're an investor, you're automatically a member. If you're a member, you're automatically an investor.
Okay.
You see what I mean? So when they come in, that's what that's there for. And we got to keep our network, our bubble in place so we can keep expanding and stuff. I say it's a bubble, but not one that's going to burst. But like I said,
right.
It's a bubble that creates, because you remember, you use a bubble machine, you'll blow the bubble, you create more than one bubble. You see what I mean? But we're all interconnected to one another.
Okay, so with the economy and regulations and things like that you have to go through in order to create an organization like this, what do you feel would be one of the deepest struggles that you had to overcome throughout this process?
Just the marketing hype in regards to the how they're using the crowdfunding methodology, how they're infiltrating the venture capital methodology within the crowdfunding methodology. When I go to the crowdfunding, so I went through a few crowdfunding sites, and I got rejected from a lot of them because they're which pretty much just uh, uh, prove what I was talking about, that they're made up of the venture capital methodology, and they're using those. And what I mean by the methodology is that, remember, venture capital is only funded 1 to 2% of the money to small businesses to start their businesses, right? So, and that's the reason why the Jobs Act was created, and part of the reason why it was created, to have people more access to capital. So if you're bringing that methodology over into the crowdfunding, that means you're continuing business as usual. You're manipulating the crowdfunding method to access the public, the crowdfund. You see what I mean?
Mm-hmm.
You can't use that same venture capitalist methodology on a crowdfunding platform. So that was a lot of the headaches that I was dealing with and stuff like that. And it's not that they didn't understand what I was doing, they just didn't want to put that on their platform, because pretty much that exposed. You can listen, if you listen to the way that I'm talking, boy, it'll scare folk. Think about it, it'll scare them. It's like, man, this dude got too much. This knowledge here is, oh man, no, I don't want to get all into that, because they don't want to get it, because they always feed that off to attorneys and stuff like that. And I know for a fact attorneys don't want to get into I don't have no law degree, but guess what? I make it a point to make sure that I know other people's jobs before I do business with them or I speak to them. I make sure I got my stuff on point, because if you don't, they can manipulate you.
Mm-hmm.
So I don't get, so none of them, attorneys don't get into conversations with me on that level, and these guys don't get onto that level. So that was kind of some of the issues that I was doing. But the remedy to that was Reg A. So like I told you I think I told you the other day, on the 13th we filed our Reg A. So Reg A eliminates the crowdfunding thing, and takes us to the next level, to where that's literally a pre-IPO, an IPO. We're getting ready to do an IPO. When we file the Reg A, once that's qualified, we're ready to apply. And well, we can go through that process right now. We can go ahead and start the application process. And that's why we're trying to get people involved right now, because when that Reg A is qualified, before that Reg A is qualified, we want to make sure that we going through, we get X amount of money in here to pay for the application fee, pay for our QSIP, get our QSIP number, get everything registered and stuff like that, get our application with the New York Stock Exchange American. Once all that is ready to go, by the time that qualification is on, then we can decide if we want to list the trade right now, or raise a little bit more money to get in, get a higher valuation. So then we go get on, and then our stock price goes in. So that's the remedy to that. We don't need a third party intermediary once the Reg A is qualified. That eliminates that headache that we were dealing with. Because I've had a lot of people say, "Oh, no, you can't do that. But you need us. You need us to do your Reg A for you. Oh, we need just to do your crowdfunding filings for you." See, I know how to do all my filings with the SEC, Edgar. I learned that 15, 16 years ago. I already knew the process. I already knew the steps. I knew how to get my CIK number. I already knew all that. I've already been tailored with how to get a QSIP number. All of that I prepared for this day. I didn't know this day was coming, bro. You know what I'm saying? So yeah, so that's the things there. Those little things. People trying to tell you what you can't do. We need you. We need to do this, and you need to pay this. All these. It created all these companies that are doing nothing but money grabs for businesses that do not know the process, and they're thinking that this stuff is new, but it's not new. You see what I mean? It's not new. It's already was being done, and they know that they see that I already know all of that already. So they just push me aside. You see what I mean? But this is for my niche market. Hey, I know what I'm doing. I got it. come on in, so we can move. We don't have to worry about these knuckleheads and these headaches and stuff trying to stop it. They just don't get involved. They don't reap the benefits. That's all it is.
Okay, we kind of touched on this a little bit earlier, but let's go back to go just slightly a little deeper. Who is your organization best suited for?
Non-accredited investors, but it's open to venture capitalists and also institutional investors over a period of time. So it's a stair-stepping process. Non-accredited investors, they're highly recommended to get in if we're going to stack their asset wealth on the security side at an affordable cost, and then it can stair-step into the venture capitalists or at the same time, as long as the venture capitalists know they're on the same level, and then we'll stair-step our way up into the institutional side once we get ready to apply for the New York Stock Exchange, American. And and the non-accredited investors, that's anybody that's not making $200,000 a year. There's rules. They have limits on there. And if when you go to my site, it's there. Go to the website, or you go to our crowdfunding site. It shows you those limits when you leave in those disclosures. So where what you are, and when you're signing up, it's going to ask you if you're an accredited investor, and then you'll just follow those guidelines, and you'll know what you are, based on your answers.
Okay, so what are the three main benefits of becoming an investor with CC Group?
You being a member of a larger a cooperative network, equity, and the fact you're able to actually build generational wealth through shareholdings, in lieu of real estate, cash flow and real estate assets. I think those are the three things that people really focus on is how am I going to build my wealth? Assets, you need assets, but I want to do real estate. Well, this is one way that you can buy stock. That capital in turn buys cash flow and real estate assets, which is the other benefit. And the fact that they don't have to manage, and they don't have to, do anything other than, just receive their dividends and whatnot, and leverage their assets to buy, what they need within their community. So it's just that simple. They don't have to come to me and ask for anything. They have their asset to where they're able to utilize and move freely without any type of restrictions, which real estate funds and REITs have on them.
Now, I know this next question is on everybody's minds. What type of returns can people expect when they invest with your organization?
Well, we touched on this earlier about the concept of about the ROI. Like I talked with one of the angel investors yesterday, they're only focused on the ROI, one formula of the ROI, so and that ROI, you're not going to know when you're dealing with us. You're not going to know it. You'll be able to calculate. You have to calculate your ROI after you receive everything first. Okay. Because the normal ROI, and I'll keep this brief, the normal ROI is the return on your investment. For the people who don't know, it would be your investment plus the percentage that they give you. So if you put $500 in, you get a 10% return, you're getting 50. That's all that you're getting back. So that formula is the simple formula, and everybody focuses on that, but they don't know there's another formula, which is the same formula, but you got to add in everything that you receive from the company, and then you calculate your return on your investment. So now, since you're not getting a percentage, you're not getting a return, an annual percentage. Now you have to move to that second formula. And that second formula, so that means if you put $500 in and you got 50,000 shares, and then we go public and it comes at $10 a share, now you have to that's $500,000. Now you got to calculate that in. Then you got to calculate in your annual dividend. Say you get a two cents per share profit, right? Every month from the real estate, whatever, just say, right? So that's 2%. That comes out to $1,000. Was that $1,000? 2 cents times 50,000. That's $1,000 a year. So now you need to take $501,000 and calculate that in. So now you got 500 for that whole annual basis. You got $501,000 right then, but you still got your asset, right? That's your value. That don't mean that's the cash that you cashed out. That's just what your value of your investment is. You take your $500 that you have, and now you calculate what your return on your investment would be, because now you put in $500, but now you got $501,000. Now you do your ROI. you see what I mean? Yeah, so that's the difference, because you're calculating. You want to calculate everything that's your return. I put in $500, but I got $500,500 back that I have access to. That's your return on your investment. And you can do the calculation on that and figure out what that is. You see what I mean? So
okay, if anybody is interested in getting started with CC Group, how can they get started?
Well, one, they can go to www.ccg.coop. And from there, if you go to the main website, you can hit invest now, and that'll take you to our crowdfunding site that's up for right now until where you guys can get to start to invest, read everything on the site, all the perks and the bonuses that we have available in there along with your investment. We want to make sure that you get more value than what you're actually putting in. You also have access down at the bottom. You'll have access to the disclosures, the SEC filings for the crowdfunding as well, and then your ability to go ahead and sign up and invest everything on that site. It gives you everything that you need over there. But like I say, but you can go to the main, like I said, go to the main site, the ccg.coop. You can go to the blog pages, go to the media pages. There's videos, YouTube. You can access everything from there, so that way you can start educating yourself, reading, listening. Got articles on Medium with different storylines. We're on TikTok as well. We got one video up there. We're trying to build that network base of the information, and I'm trying to make them uniform across all platforms. Because that's kind of hard because you got time limits on certain things. But YouTube, definitely there. You have to listen. You have to listen to. I know it might be hard, and I know that people have short attention spans and stuff like that. But this type of information and knowledge needs your undivided attention. And trust me, you won't get it on the first run. You have to listen to them. You have to keep listening to it until it clicks. Because remember, the stuff that I was learning in 1996, 97, some of it didn't click until 2003, 2004. You know what I mean? And the stuff that I was reading in 2009, it didn't click until later on and stuff like that, until I was put in a situation or a scenario to where that consciousness fit in that consciousness right there. Oh, those are the connectors. And okay, that's what that meant. You see, so you kind of got to go through that with it and stuff like that. So all that's there, all that's readily available. When you go to the site, sign up for a prospective investor account. Get your information into the database and stuff like that. So if you invest, you'll qualify for a lot of things, because I'm doing a giveaway until the Reg A is qualified. I'm giving away 50 million of my own shares to the first 2,500 people who sign up and invest at least the minimum. So you want to make sure that you get yourself situated into that, so that way you get those extra allocated shares to you on top of your investments.
Okay, Tannen. So what is the main feeling of gratitude that you have since developing Consumer Cooperative Group?
Man, just reaching out. Reaching out to the people. If you look at everything, you might think there's not a big response, but you might not see it on that end, but on the back end, there's a lot going on in the company on what you don't see. So there's a lot of feedback, there's a lot of questions, a lot of interactions. There's a lot of going on questions that people are asking. And it's exciting it gets me excited when people are asking them right questions. You know what I mean? Those not necessarily that there's a wrong question, but those specific. Let's put it this way: those specific questions when they're getting into those details. You see, so now I know that they're going through their learning process. They're stacking with the questions and stuff like that. They're stair-stepping because they're trying to bridge that gap from what they've been. Not been told to what I'm saying, so they're bridging that gap in between those two mediums. So that way they're like, okay, I see this because I've experienced this. Because a lot of them don't realize that they're already experiencing and they've already been going through those motions of everything that I'm talking about. They've already been doing it, but no one has put a shine the light on that. Because remember, I was telling you that I was doing stuff in business that I was already doing. But then when I get to college and they're talking about it's got a method. It's called. I said, how's that called? The name? Who took claim for that? I was like, I naturally knew that. You know. So you have to think about it. So people already co-op. They just don't know it.
Right.
They don't realize that they're co-oping already. You co-op every single day when you pay your taxes. When you go buy products and services, you see what I'm saying? Buy cars, you do whatever, you're buying all that, you're co-oping, but the company's not calling themselves a co-op. You see, but you're co-oping. Everybody's pooling their money together. Everybody's getting your pooled funds, but you're not getting anything back from those pooled funds. So I want everybody to think about that. So if you're paying an electricity bill, so just think about you're paying billions and billions of dollars in electricity bill. See, you just pooled your resources. When you go buy that lottery ticket, you're pooling your financial capital for a chance to win something. That's the best example right there. So if you don't win, you just gave your money away for free.
Yeah.
You see what I'm saying? So think about that. Just think about you going out to dinner. Same thing. You're giving your money. You're giving your money away. You're getting something to meal. That's only temporary. You're only getting when you're giving away and pooling your money. You're getting chances to do things, and you're getting temporary lapses of a good feeling for that minute. But that goes away. But when you invest and co-op with us, what happens is that feeling stays with you, because as long as you own that stock, that stays with you. That value, it grows with you. It becomes a part of you. Okay. So just remember that you co-op. So you choose the way that you want to co-op and pool your money together. You want to pool it and give it away for free, or do you want to co-op and pool it and build generational wealth that you can pass down to future generation? That the choice is yours. It's always been your choice.
I hope you've enjoyed this episode of Features with Tanen Andrews of Consumer Cooperative Group. If you'd like to be our next guest on Features, just contact us at UnitedStatesRealEstateInvestor.com and we will get back with you shortly. If you found value from this episode, Please share with all of your friends, family, colleagues, anyone who would like to know more about what Tannen is building, and also share it with someone you think may be interested in being a guest on Features. To learn more about Consumer Cooperative Group, visit ccg.coop. That's ccg.coop. This is Antonio Holman, founder of United States Real Estate Investor, and thanks for listening.
Universe Media Mastering. Your audio more listenable.